Hey fellow traders, in this video let's talk about turning drawdown into equity. As one form of forward progress, I'm going to be reusing the last scenario that we had to show this example. It's not really so much about the chart, but more about the concepts of what's happening. And by showing this, we're going to also be seeing another form of a hedging strategy. And using this same chart, we'll have a baseline to compare that to how we came out in the end with our compounded size. Now, using this approach could also be a better option if you're a more conservative trader. You don't really want to use as much risk as a more aggressive style trade. But either way, no matter how you trade, you're going to find yourself using this in a lot of situations. Now, before we get started, if it's your first time here, be sure to check out that Hedging 101 playlist. Each video is going to build upon the last and expand on each concept and add further tools to your tool belt. And if you find any value in these videos, just give it a thumbs up. It lets me know I'm doing a good job and it helps the channel out. Alright, let's head into the testing ground. Okay. Now I'm taking the liberty to go ahead and bring us back to the start. I'm going to go ahead and zoom out because I've got a little bit different screen recorder, a little bit better screen recorder, so I can go ahead and show the overall chart. And for this, starting out, we're just going to show the same ideas, the same kind of trade as we did before in the last video, but this is going to be with a strategy that has a little bit less risk. And just like before, we started with a $100 account. A lot of times you'll see me testing or showing ideas with a $100 account. The main reason being is because anything that goes wrong, you're going to see it pretty much immediately. Now I'm going ahead and just double checking all the prices, spreads, everything's set up to be similar to what my account would be. I've got a $2 commission, $4 round trip. Swap is counted in points. So everything is set up good to go. So let's go ahead and start. And just like before, we're going to go ahead and take an immediate sell because the idea from the last video was at this point it's just consolidating around. We're going to look at this as if it was going to go back into consolidation because we don't have a very strong breakout here. So that may be a common kind of idea in this situation. And this is how you could handle it if you were not looking to take an extreme amount of risk. So what we've done is we went ahead and took the sell, and we're going to figure about 30 pips of risk. This is going to take at a 0.01 on the Euro USD, 10 cents a pip, and it's going to take about $3 out of our account if we get hedged. So we'll go ahead and place that order there and play through some price action. And just like before, we got hedged out, and you came back and you saw this. So what you would do in this situation is just like before, you go ahead and close the position that's in profit. But instead of going and adding back in, you're just simply going to place another buy stop with another $3 or so of risk. And as you can see, just like before with the first trade, we just got that $3 in risk. But now if we get hedged, instead of going down a total of $9, we're now only down a total of $6. So it's a little bit more conservative. It's not as noticeable at first. And one other thing to take into account is we're not compounding our position. But we got hedged, so we're going to go ahead and hold this until we get to another possible reversal point. And we're going to hold out and just wait for a little bit of certainty so we get a strong down push there. And now we're starting to get that strong rejection out of the top. So we're going to go ahead and do just like we did at the previous level. We're just going to close this position out and repeat the same process again. Now, being wrong the third time is when the benefits of this method really start to show up. Because now when we're at this point, we're only at we're at about roughly $94. So like I said, we're about $6 out. Whereas before we were $9 out of this point. We had about $91 in equity. Now, in our last situation, we compounded in and we took 3 different sell positions. So this would have been our final opportunity to get it right, or we would have been at about $81. In this situation, you're only going to go down to about 90 to 91. So with this strategy, you can afford to be wrong a lot more. The only downside is when it comes to recovering that drawdown, which you can see as it starts to come back, now our equity is going to go back up. And just like before, we can always close this out right as soon as it crosses that $100 mark. And we can be exactly flat with no losses, all our fees and costs, the swaps, and all our trade adjustments. Those are all accounted for, and we can just simply close out. And now to talk about trying to get more out of it. This hedge order right here can actually be treated just as a stop loss when you have this type of situation going on where you're open in one direction and you want to lock in those gains as you're gaining back that balance. And as it continues to move, your balance is going to start slowly converting into your equity. So at this point, we're going to continue to just kind of hold out and trail down. And what I normally like to do for my trailing type strategies is when we're going down, I'll go with the most recent obvious high. And then other times you may get a strong push, and you'll definitely want to start taking more ground as soon as something like this pops up. So in this situation, I'd go ahead and just keep moving it down, keep going, and you can see at this point we're starting to make some equity gains, make some profits on that initial position. And even though we took that position way down here, this distance that has been coming down is actually working as if we took this position up here now. So in the idea of compounding like what we had before, it didn't really matter too much where these positions were. It's just the simple fact that we had it. And it's just like when we were talking about in the risk video, it's kind of more about your exposure. And that's going to come into play a little bit later on when we start talking about other topics. Like, for example, if this hedge order were to get triggered and then price comes down and you're in the middle, but both trades would be at a loss. So there would be a way to handle that situation as well. We'll get into it in a little bit later video. But we'll just continue this same strategy here and keep following along. And then being as this order is like a stop loss, once it finally does get hit, everything equalizes and the equity will stop moving. So you can simply choose to close everything out at that point. Or one other thing you can do, which this strategy allows because you're not getting such a massive size, you could continue this pattern of just allowing this up, close it out until it eventually passes here, and just keep working that back and forth. Then you'll also build up some equity, and you'll also have a little bit more money to work with in the future for when that inside situation comes up. But for the purpose of this video, I'm just going to close all of the positions and orders, and I'm going to talk about that as another benefit, because one other thing that I've noticed throughout the testing and throughout several strategy runs and doing these different methods, I found it's a lot better to, regardless of which method that you're using, to go ahead and close out whenever you get into a situation where you were making some money and then it stops once you've crossed your positive equity. It's a better idea to go ahead and close out and start a fresh trade from there. That way you go ahead and realize that gain, you go ahead and lock everything in, and now you have a higher account balance. In most cases, it won't always work, but in most cases you can generally get this equity above where you started and basically flatten out and just completely start over. It tends to give a little bit better results in the long run in my testing. But that's it for this video. I'm going to wrap that up. Before I go, though, I will propose one other idea. This will give you a little bit more aggressive risk, but it still doesn't quite build as much as where we were trying to take every point. One thing you could do to kind of speed things up but add more risk would be when you take that second hedge order out of the market. So basically, every second attempt, add back in. Because if you add in up here, then the break even point for your account and your equity is going to be raised up a bit higher, because basically instead of needing to recover both 60 pips out of both positions, by adding in every second one, you would only need to recover the 30 pips coming back. So it would get your recovery done a little bit quicker. You could actually get recovered by about this point here, and I'll go ahead and back it up and show that while we have this available and set up and going here. They do have a search function in here, but you have to go by date. It's a little bit easier just to back things up. So let's say we went ahead and sold that out. Not sure if that's going to open back up. I think it might. There it goes. So we'll go ahead and repeat the sell process. But then we're at our first attempt, second attempt, third attempt. So every odd number attempt, you could go ahead and add a second one in, and then make sure you're equally balanced in the opposite position. And in this situation, it doesn't put you too bad off if you do end up in a hedge. Make sure we're in a good spot there. And let's see, double check everything. Yeah, we're good to go. But it will help you regain that a lot faster, and also give you a little bit more leverage. And this would be considered more of a moderate risk strategy. But going back on the equity part now, at this point, we would be removing about $6 from the equity. So we would be looking at somewhere around 86 if this hedge did get hit. But notice how much faster the account is able to come back to break even. It only takes just a couple of hours, just like the method before. So that could be one way to get a little more aggressive if you're trying to get out of the trade quicker. Or if you really wanted to play it safe, you could just stick with the squeezing down or trailing down. Really, all you're trying to do is just continue locking in those gains. Like I say, oftentimes it could be referred to as squeezing, or um, basically just converting your drawdown to equity. I think squeezing is a pretty good term for it, even though it has a different definition in stock trading. But I think it kind of summarizes what's going on and what you're really doing. So I think I'll just probably use that term as referring to that technique. But I'm going to go ahead and wrap things up here before I make it too long. And I'm going to leave you with that. And I'll catch you on the next video.